In a world where the US dollar has long been seen as the safe haven reserve currency, the specter of a sovereign default in the United States is still treated as remote. Yet, the mounting federal debt, the ballooning interest burden, and deepening political stalemate raise the question, what if the US simply cannot pay its obligations? The trigger might be a failure to raise the debt ceiling, or an abrupt spike in interest rates making debt servicing untenable. If investors lose confidence in Treasury securities, the ripple effect would begin at the heart of the global financial system. The dollar could weaken sharply, bond yields soar, capital would flee risk assets, and the old assumption of perpetual liquidity would fracture. The tipping point has arrived, where the world begins to doubt that the world's most powerful economy can live up to its promises. Understanding how the US accumulates debt is critical to grasp the severity of a potential default. The federal government borrows by issuing Treasury securities to cover the gap between revenues and expenditures. Recently, interest payments alone topped $1 trillion per year, meaning more budget goes to paying past debt than to new investments. As the ratio of debt to GDP rises and servicing costs climb, fewer resources remain for infrastructure, education, or innovation. The risk lies not just in absolute size of the debt, but in the speed at which servicing demands escalate. If growth slows while borrowing costs increase, the burden becomes self-reinforcing. Faster borrowing, higher interest, more borrowing. That spiral is the anatomy of debt that can trigger a crisis. Suppose the US does approach or even flirt with default. What happens in markets? The immediate effect would be a sharp rise in Treasury yields as investors demand higher compensation for risk. According to one analysis, a sustained default scenario could lead to a steep fall in the dollar and widespread dislocation in equity and credit markets. The safe asset status of Treasury bonds would be called into question, triggering a global scramble for alternatives. Banks and institutional investors holding US debt would face valuation losses, perhaps even requiring recapitalization. Credit spreads would widen, borrowing costs for corporations and governments alike would spike. The domino effect would move swiftly from US treasuries to emerging markets, commodities, currencies, and global trade. One of the most ominous outcomes of a US debt repudiation would be a currency crisis. The dollar's dominance as the world's reserve currency rests on confidence in the ability of the US government to pay its bills and in the liquidity of its financial system. If confidence falters, foreign holders of dollars and treasuries may sell assets, pushing the dollar's value down. A weaker dollar raises import costs, fuels inflation, and squeezes consumers. Corporations with dollar-denominated debt face higher servicing costs. Exporters might benefit short-term, but instability of the currency undermines long-term planning and global trade contracts. Suddenly, the privileged status of the dollar becomes a vulnerability rather than a strength. Beyond global markets, a US default would carry serious domestic consequences. The government might be forced to prioritize payments, perhaps favoring bondholders over social programs, federal employees, or veterans. Interest and principal owed on treasuries might be delayed or reduced, eroding trust in public institutions. Spending cuts and tax increases would likely follow to stabilize finances. Consumer confidence would erode, triggering job losses, business investment pullback, and a sharp slowdown in economic growth. The risk of recession would spike for average Americans, rising borrowing costs, disappearing government checks, and volatile markets would translate into tangible stress on household budgets. The US economy doesn't exist in a vacuum, so a default would trigger global dominoes. The dollar underpins most international contracts, commodities are priced in dollars, and many central banks hold treasuries as reserves. If U.S. Treasuries lose their safe asset status, foreign holders might dump them, pushing global yields higher. Emerging markets dependent on dollar funding would face capital outflows, currency collapses, and rising debt servicing costs. Commodity exporting nations would suffer from currency mismatches. The global financial architecture built on the pillar of U.S. debt would wobble. In short, the world economy's plumbing involves the U.S. dollar. And if that pipe ruptures, the flood is international. A sustained breach in the dollar's credibility could spark a longer-term shift away from the greenback as the primary reserve currency. Countries might diversify into other currencies, euro, yuan, yen, or broaden gold and asset-backed reserves. The network effects of the dollar system unraveling would mean higher transaction costs, currency hedging frictions, and less efficiency in global trade. For the U.S., losing reserve currency status would raise borrowing costs significantly. The financing advantage of issuing debt in one's own currency would diminish. Strategic geopolitical implications would follow. Countries might push for alternative payment systems, reducing U.S. influence in the financial sphere. The risk is not only economic, it's strategic. Faced with a potential default, policymakers have limited tools, and each comes with trade-offs. The Federal Reserve might step in with emergency liquidity, but monetary policy cannot indefinitely substitute for fiscal discipline. The federal government could raise taxes or slash spending, but both risk throwing the economy into recession during a fragile period. Another path: restructure debt or engage in a managed default, damaging credit for years. Legislators might raise the debt ceiling at the last minute, but such brinkmanship undermines confidence anyway. In the endgame scenario, we face three broad outcomes: a rapid resolution and return to status quo, a drawn-out era of stagnation and subdued growth, or a dramatic crisis that resets the global financial order. For investors, the ramifications of U.S. debt default are profound. Equity markets may gyrate violently, fixed income portfolios could suffer major losses, and safe haven assumptions would need reevaluation. Corporates with dollar-based debt or revenue streams face amplified risks. Multinational companies might struggle with hedging costs, dislocated supply chains, and volatile consumer demand. Private equity and real asset managers would reassess risk premiums. The cost of capital would rise across the board. For sovereign wealth funds, pension funds, and insurance companies holding U.S. treasuries, asset-liability mismatches could emerge. In short, a default would force a radical rethinking of global asset allocation, risk models, and capital structure. While the scenario is grim, it is not inevitable. The U.S. retains unique advantages: the depth of its financial markets, the liquidity of the dollar system, and global trust built over decades. To avert a collapse-style outcome, policymakers must act proactively, restore fiscal sustainability, reform entitlements, and maintain transparency. For markets, scenarios must be stress-tested and diversification reconsidered. Corporations should evaluate exposure to dollar funding, currency risk, and supply chain flexibility. For individuals, building resilience, holding a mix of assets, guarding against currency risk, and keeping time horizon awareness becomes more important than ever. The collapse of the dollar isn't foreordained, but the risk is material. In the interconnected world of global finance, the resilience factor may determine whether this becomes a manageable hiccup or a full-scale meltdown.